This is the second video in the two-part series on zero interest notes, or perhaps you could call them discounted notes. So since this is Intermediate Financial 1, we're dealing with the asset side of the balance sheet. So these are going to be a note receivable. Of course, if this was you borrowing money, it would be a note payable, and all the numbers would be exactly the same. It's just that every time we get cash, you would pay it. So it's quite easy to transition with that same knowledge from a note receivable to a note payable. Now, once again, you're going to need your financial calculator because this is a zero interest note. The difference between this and the first video is that this note is going to be paid off in a series or with a series of equal payments. So we receive a note for $24,000 at 0% interest, and it will be repaid in 4 equal yearly payments. So first of all, I guess this isn't too tough, but we have $24,000 which we need to collect, and we're going to collect that in 4 payments. So the payment is going to be $6,000. Now, this is listed as or signed as a zero interest note, but the market rate is 8%. So as with the previous note, you'll notice there is no such thing as free money. We need to figure out the present value of this note. So if you think of your time value of money functions on your financial calculator, we have a payment of $6,000. We do not have this, sorry, that shouldn't be there. We have a payment of $6,000. We have future value of 0. Now this is important. Sometimes students get this mixed up. The future value is not $24,000 because our customer is paying the note off with 4 payments of $6,000. After the 4th payment, they don't owe us any money. So do not put in $24,000 as future value. Put in 0. Your interest per year is 8, and there are 4 periods. So when you put in those 4 pieces of information into your financial calculator and you hit the PV key, you will get 19,872.76. So that is the present value of the note. So when we receive this note, we're not giving that customer $24,000. We're giving them 19,872. So our first journal entry is to just accept the note. So you'll see here, this is the discounted value of the note. So I'd like to go back here and look at this amortization table. Now this is really similar to a bond amortization table. What I'd like you to notice is that this note has to go from its present value down to 0 over the 4 years. We have to finish it at 0. And of course, 8% interest on $19,000 is not $6,000. So when our customer pays us $6,000, part of that is going to interest, and part of that $6,000 is paying off the principal. So what we're going to do is we're going to take this beginning carrying amount of the note, we're going to multiply it by 8%. And if you just look at my formula up here, if you wish to, you'll see there's the formula in that cell now, and we've calculated 1 year of interest at 8%. So $6,000 is the cash we receive minus the interest, means the debt goes down $44.10. So we're going to take this carrying amount, we're going to deduct $44.10, we'll get $15,463 above. Okay. Now, when you're doing a table like this on Excel, I mean later on you're going to be doing a bond table. What if it's a 20-year bond that pays interest 2 times a year? You don't want to copy this formula or like write out this formula 40 times. So our payment is constant. This is a formula. It says, take this number, multiply by 8%. This is a formula. It's just saying, take this number, subtract interest, determine principal, and of course, this is a formula. It's saying, take the current carrying value, subtract the principal repayment, and calculate the new one. So I'll just show you this. Let's say that wasn't there. If you want to make your amortization table on Excel, you just take this and you copy it down, and there's your amortization table, just like that. As long as it's all formulas, you're good to go. Now, this is kind of off track a little bit, but let's do it anyway. What if this was that 20-year bond that had 40 interest payments and you needed to do an amortization table for the whole thing? Okay, that's going to cause you perhaps to count 40 rows. But here's what you can do. I'm going to show you a neat little trick. Once you have your first row, now again, you sort of have to pretend that we don't know what row is the maturity value. Here's what we do know. We do know that when this note is paid off, the book value will be 0. So if this was a long bond with 20 or 30 or 40 payments, I would just copy this down a long way, like that. And even if this said 6,000 from before, even if this was a column of 6,000, notice that here I copied it down a long way. Here is where your note is paid. So all you need to do is just delete these, and you don't even have to count the rows. Now that would have been a little more effective if I'd had a whole row. So, in a bond issue, we could have had the 6,000 in there as well. And the idea is you don't actually have to count the rows. Okay, so we've looked at our first journal entry that we need to receive the note. The first interest period is we're going to get cash, we're going to earn interest revenue, and the debt that is owed to us goes down. So let's look at the journal entry. And you'll notice that this line right here has all the numbers we need for our journal entry. So we're going to get our cash, we're going to get our interest revenue over here, we're going to reduce the note receivable with a credit, and that first line was the first line of our amortization table. In year 2, similar, here's the second line, here are all the numbers from the second line: credit interest revenue, credit note receivable. So you'll notice at the end of year 2, they only owe us $10,700. So for example, if our customer came into some money and they walked in to see us at the end of year 2 and said, hey, I want to pay off my note, all you need to do is get the rest of it, right? You don't have to earn all this interest. You don't have to collect, you would not actually collect 2 more payments of $6,000 from him. If you wanted to pay it off today, you would just say, okay, give me $10,700, and that would be it. You'd be done. So you can't collect interest you haven't earned. However, in year 3 and year 4, we're going to earn these amounts. So here's the journal entry for year 3. Here's the journal entry for year 4. Key fact here is if this is a 0 interest note and it has payments, then it's going to go down.